Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, September 8th, 4:15 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in a correction. You can see over here on the trend gauge, we have had some improvement, certainly, over the last 2 days. As you look at our designation for leaders is neutral, but the arrow has shifted from red. Yesterday it went to neutral. Today it's going to green. Some really good action out of some leading stocks. As far as the indexes are concerned, all five remain underneath the key moving averages that we track. That's the short-term 21-day exponential moving average, the medium-term 50-day moving average, the long-term 200-day moving average. What happened today? Day two of strength with leadership. We started out with a gap down, pretty ugly gap down actually. We down 0.7 on the S&P, 1% on the small caps and on the NASDAQ 100, but we put in a low pretty quickly, had a strong trend up to green, a harsh sell-off attempt in the afternoon, but the bulls bought it up and got us back to firmly green by the end of the day. Definitely a win for the bulls today. You can see the numbers here. G6 growth stocks led today. G6. This is our in-house 6 ETF composite, up 1.5% on the day. S&P 500 up 0.7. NASDAQ 100 lagged all day but closed the gap on the S&P toward the close, up 0.5%. Dow up 0.6%. Mid caps up 0.9. Small caps up 0.8. Global diversified 60/40, big laggard, only up a fraction, up 0.07%. GROTECTION lagged today. We took a dip on the short side and then bought two longs. We'll talk about that as we get into the charts. Down on the day, just fractionally 0.05%. So let's get into the tail of the tape, and then we will get into the charts. And first, let me describe what we do here at Revere. Trend following is what we do across 3 time frames and tracking leadership. So last November, this is an example of a very healthy market. You've got your short term, the green line, 21-day exponential moving average above the medium term 50-day moving average, and both of those above the 200-day long-term moving average. When we're trending like that, we have as much capital allocated into the market as we're comfortable having. When we start to roll over, the market will take us out. Our stops will start getting hit, and we'll lighten up on our index exposure. If things start getting weak, if we really start to weaken, you'll see the slope of these lines start to curl over, as happened mid-January. And if things really start to get messy, we'll break below the black line, the 200-day moving average. You can see we chopped up and down through the 200-day moving average in January, February, then again in March, but we had a big leg down in starting on April 21st. Really not a surprise to anybody that tracks the indexes below the 200-day moving average. Let me bring up my favorite chart here as a reminder. This is why we protect our clients' capital. You do not want to have a negative sequence of returns as you go into retirement, because you just don't have enough time to recover from it, and your standard of living could really be impacted. We just get you out of the way, plain and simple. We've got rules. We're down 6% year to date. The indexes are down 15, 16%. And it's just following our rules, getting out, getting back in. Once you're under the 200-day moving average, we look for short-term signals to get us back in. Primarily, once we get above the 21-day exponential moving average, we never know how far that's going to take us. There was a very nice 5-6 week rally off the bottom here. It topped when we ran into the declining 200-day moving average. We started taking some money off the table, still profitable from this trade. And now we're trying to bounce off this 3,900 level. Today was day 2 up. And really some good signs today. The Bears had an opportunity to take the ball from the Bulls, and they failed. So we initially went short, and then, as I said, we had our leadership scouted out pre-market. When we got some good opportunities from them, we took them. We'll take a look at that momentarily. Also want to note a tailwind for the Bulls from oversold. This stochastic cross-up happened today. Started yesterday, happened today. You can notice when we get these crossovers and we get above the 20 level, that's considered oversold, going from oversold to neutral. You can see that the market rallies along with those. So it's a signal that we use, just another tool in our toolbox, as determining whether the wind is in our face or at our back. Let's go to the rest of the indexes very quickly. NASDAQ 100. Stochastic cross, second day up, still beneath the declining 21 and the 50-day moving average. This goes for all of the indexes. So resistance just overhead. If we fail there again, the way we did, let's go back especially to Monday last Friday was the big failure. And this was kind of what I thought we were seeing in the middle of the day today, a failure into these moving averages, but we reversed and finished higher. And so far, so good. 2 days. We'll see what happens when we get into the directly overhead resistance by way of those moving averages. Not only the moving averages, but this 4,000 level. You can see the market battling at that 4,000 level, really going back to May. So price has memory. You look left to see what happened, what was support, what was resistance, and if you break through it, it's good for the bulls. If you fail at it, it's a feather in the bear's cap. NASDAQ 100 we showed. Let's go to the Dow Jones Industrial Average. Here's the diamond, same thing, 2 days up off the low, running into the overhead moving averages. Here's mid caps. One close above the 50-day moving average, now coming into the 21, the declining 21. So the first of the indexes to get above the 50-day moving average. Small caps right on the 50-day moving average. So making an attempt, I'll be the first one to admit I've been bearish on the recent action, but you got to keep an open mind. Anything can happen. Everybody, including myself, was bearish back here. I remember this day in particular, July 14th, looked like we were fading and going to make lower lows. We had a positive reversal, closed at the highs. The next day we gapped up, got above the 21, tested it for a day, and then we were off to the races, started pulling back and had a very good rally. And there's no reason why we can't have another one of these rallies. But again, we'll see how what happens with the price action and follow the rest of our indicators to see the good and the bad, as well as the ugly in the market. Let's go to the tail of the tape here. I added this tailwinds line to indicate the indexes and the G6 all had daily stochastic oversold cross up. Again, that's a tailwind. Means, you can't go down forever. The market doesn't go in a single direction forever. We went down. This has been a nice pullback. Maybe it's just time to go sideways and rest before we go lower again, or maybe it's time to turn to the upside and make another attempt at new highs. Don't go by what the headlines are. Go by what the price and the volume action is. Put calls at 0.96. VIX was down today, back under 24. That's bullish. Closed at 22. Right now it's at 23.61. This changes quite a bit. It's still open and it trades after hours. 23.61, down 4.2% on the day. That's also bullish. Fear and greed is at a 41. We're still operating under the bear case since 8:26 when Jerome Powell's speech killed the rally. Some news today, the ECB raised 75 basis points. In the U.S., initial jobless claims were lower than expected. This is actually a negative. We went lower pre-market on these two headlines because jobless claims lower than expected it still reflects wage inflation, and that is going to trickle down to overall inflation. Notes, we went from day one up to day two up. Powell spoke today, just like all the Fed speakers yesterday, stressed no premature policy loosening. The model or the market seems to have adapted to that during this most recent pull-off. They keep saying it over and over again, and we've stopped going down. We'll see if we continue to go higher or if we just run into resistance. Expectations were negative to neutral today, negative because we're under the key moving averages, but a strong up day yesterday, followed up by a strong day two up. So going more to neutral than negative on the expectations. As far as support and resistance go on the S&P 500, we rallied up into this resistance area today. Let's see if we can take another shot at it tomorrow. NASDAQ 100 spent the day between support and resistance. So let's take a look at this hard fade in the S&P 500 that I was talking about. This is when we took we were flat all in cash coming into today. Sold too early yesterday, missed most of this run. We gapped down. But it was bought immediately. In the first 15 minutes, we trended higher, made a higher high above yesterday into this 40.11 area. But then there were some headlines out of ECB, and the market got hit hard. We went down over 1% in 10 minutes. And this is when we broke this 39.80 area. It was 39.80 because it coincides with yesterday's high. It was really between 39.90 and 39.80. Yesterday's high, the 8 EMA, and when we broke those, we put the SDS on. We went down to 39.53 and then started bouncing, working our way back higher. We got up to 4,000. We based right along there. A little bit of a pullback, but strong into the close. So we're underwater slightly on our SDS position, but from our pre-market work, we had prioritized a couple of things. CCJ, uranium, this story isn't going away. Relative strength at a new high, had a failed breakout here, but Monday was weak in the markets. Bounced off the 8 EMA yesterday, followed through to the upside today. This 30 area is critical. Basically, we came back and we based around this 28 area, and when we lifted off there, we took a quarter size position in that today. Other stock that we were looking at, nobody's been talking about this since it started selling off with this failed breakout, but ON Semiconductor, the story hasn't gone away, excuse me, and we had the positive stochastic cross from oversold and some volume as we moved back up through the 21-day exponential moving average today. I like how we came back and based around the 67, 68 area, which were these prior peaks during the base. Prior peak here, we broke out above it, back tested it, broke out again, back tested it. Let's see if we can make a new run higher here. I like the volume today after this 6-7 day pullback. Along with the market pulling back, you can see this black line here, that's the S&P 500. And it was really only the second day up, barely the second day up, as yesterday was an inside day with ON, but up through the 21, we took a 2.5 size position in there. So sectors that were strong today. The dollar weakened as the day went along, but still finished positive. Biotech, very strong. And healthcare, uranium continues to be strong. Banks were strong. Semiconductors and software were strong. Those are bouncing. Bonds sold off in the afternoon, which sent rates higher, but the market didn't care. Retail was weak. Staples and utilities weak. Gold weak. So here was our focus coming into today. We're going to go through these charts quickly first I want to bottom line it. So we went from flat to barely positive on our volatility adjusted beta, this SDS. We've got our stops in place on this if the market continues to go higher and breaks through this downtrending moving averages that we're coming into. And then we'll see if the CCJ position and ON positions continue to work. We've got a nice little gain with ON. We're just about flat on CCJ. So bottom line, day two is strong action, but resistance directly overhead. Let me pull this up a little bit so we can look at the resistance and support areas. You can see we got above this 4,000 area, closed back above it. Next up is this 40-25 50-day moving average and the declining 21-day, which is coming down quickly. It'll be lower tomorrow, a pretty steep descent on that. So plenty of resistance overhead, which we all broke in 826 when we had that sharp down day on Powell's speech. The market clawing its way back. Let's take a look at the stocks that we had on our focus list this morning. We already showed ON and CCJ LTHM. Let's go through this one. Continues to be strong. Don't want to buy. The spot to buy it if the market was better was off the 21 here. We didn't, so we don't want to chase it, but the relative strength is great and the volume is acting very well. Michael talked about this on our podcast last week when he did a dive into the lithium sector. Next stock up, CCJ, we already bought that. CMG, this was another one. This was in the top 3 for buys today. It's continuing to act well with some volume. Over the last couple of days, relative strength renewed. Really, the spot to buy it was off of the 21, but it's just putting in a really long cup and handle. You got plenty of time with this one if the market rights itself. CEG, alternative energy stock, continues to act extremely well, making new highs today. Ulta retail stock, really kind of choppy, but 3 days and a higher high here. This is just looking really good, massive relative strength over the last 5-6 weeks. BJ, which we bought the gap, got stopped out of. It's now made higher highs. Serious relative strength there also. And the two stocks that I talked about for as canaries in the coal mine, I stressed Enphase, but First Solar needs to be considered right there with it. So these are the leaders. They broke out yesterday. We want to make sure that these breakouts stay intact. Otherwise, they'll fail along with this really 2-day off the bottom rally that we're on. That's Enphase. Next up is First Solar. Got an upgrade today, didn't fade it at all, closed mid-range, riding this 8 EMA higher. This just looks really, really good. And the canaries in the coal mine that I talked about as far as whether or not the market is going to continue to stay strong. Apple was extremely weak today, and even on an up day in the market, it's making lower lows, and relative strength has just really rolled over the last 3 weeks. Made a lower low, did battle back along with the market to close mid-bar. Very oversold on the stochastic, so we'll see if we can get something going with that. But right now, you've got to have Apple recover these moving averages, if in my opinion, if the market is going to have a sustained rally. Tesla had a decent day today, no volume coming into it, but some relative strength this week. Also, we want to see this get above this declining 200-day moving average. This is the kind of stock that can lead a market higher along with Apple if it rights itself, and then we've got the stochastic cross on that one too. That's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So wrapping up Thursday, NFL kickoff tonight. I'm really excited about that. So wrapping up Thursday, September 8th, this is Don Vandenbord telling it like it is, just the facts. Remember, it's not how much you make in the market, it's how much you keep. We're not perma bulls, we're not perma bears. We flow with the market trend, and to us, it's just a common sense approach. Give us a shout if you want to find out more about it. Thanks for listening, and have a great day.